Well, good afternoon and welcome to our webinar. Before we kick things off, my name is Scott Kozak, Director of Learning and Development here at Union Savings Bank, and I'll act as the moderator for our webinar today. We have two incredible speakers lined up that are going to impart some really great knowledge and from their area of expertise on the market and what the year ahead might look like and some actionable tips and steps that you might want to consider taking. Before we get to our two speakers, I'm just going to pop up a quick disclosure statement just for you to have on the screen as I kind of tee up the speakers. So we have two great speakers from our wealth group that are going to share some really great tips with you here shortly. Before we introduce them, we actually have, you'll be in look and listen only mode for the duration of the webinar, which means we can't hear or see you, but you should be able to see our slides and hear us, and questions are encouraged. So if you have any questions, please log those in chat and we'll field those as we go through the webinar. One last thing that I want to make a note of is there's a brief 4-question survey at the conclusion of the webinar. We ask that if everyone can just take 2 minutes to fill out the survey. Let us know how we did with today's topic. Let us know if there's future topics you're interested in learning more about. And then certainly if you want to call back specifically on any of the things you hear today, there's an opportunity for you to share your information and we can reach out to you for a one-on-one call. So without further ado, it's my honor to introduce our first of two speakers. Keith.
Great. Thank you, Scott. I really appreciate it. And I want to welcome everyone this afternoon to our discussion. I think there are two phases to what I want to relate to you today. One is just a quick look back at 2025. For sure, this year has been a busy year. It went faster than I expected. And I think in some regards, it was a hectic year as well. So I want to touch on the highlights of 2025. And then I'm going to spend the majority of my discussion about 2026. And I want to walk you through my top 10 list of expectations for next year. And if you have questions as I go through those series of forecasts, please type in, send in your questions. We'll either catch it during the discussion itself or at the end. So with no other comments, let me go ahead and move into the summary of last year. We're almost through the end of 25. As I said, it was a fast and busy year. These are the main bullets that I would take both from the markets as well as from the big picture, the macro. We had an economy that's, I think, will finish the year growing. And when we started the year, everyone was expecting not only a shift in policy and some changes going on with the new administration. There were some people expecting a recession. Well, that did not happen. And it looks like we're going to finish the year with the U.S. economy expanding close to 2% year over year. I think the inflation picture continues to be one that we're all talking about. It looks like we're going to finish this year with retail inflation near 3%. The employment picture, I think, has been somewhat muddied. We saw this week news announced where the unemployment rate ticked up to 4.6. And I think that's a reflection of not only the uncertainties that came into the environment with the tariffs, but also I think we're witnessing the federal employee base being shrunk down. And I think those two forces are, I think, weighing into that number. Had a great stock market this year, had a great bond market this year. And then I think, to everyone's surprise, there was legislation that passed as it relates to tax legislation, and that was one of the big events as well. But if you were to turn to the next slide, Scott, I think probably the biggest news in my view for 2025 relates to the shift in trade policy. In April, the president announced at the podium that he was going to apply tariffs not only to specific countries for specific reasons, but he was going to apply it broadly across all countries that we do trade with. And I think that was the biggest surprise, was just the sheer size of the announcement and the scope of the announcement. It caught us off guard, clearly caught the markets off guard. We saw in the first week of the news, the S&P 500 dropped more than 12%. It was rattling, and I think it took a while for everyone to absorb what was being asked of in this new directional change in trade. But it was a big news, and I think it reverberated throughout a lot of what we were looking at and talking about throughout the summer months. And I think it was probably the biggest news event this year that we had. So with that said, let's flip over to this year, looking into 26. As we look into 26, in terms of my top 10 expectations, I think that it's fair to say I think we're going to have another year where it's going to be somewhat distracting. There's a lot going on, and I'll walk through my list of items for you fairly succinctly. Let's start with the first one. on the trade topic again, I wanted to share with you this graph. This graph I sourced from Bloomberg. They've developed through their economics group an ability to at least estimate what the average tariff rates that are being applied across all of our trading partners around the world, what that average tariff rate looks today based on what's understood to be policy. And to give you a reference or a frame of things, in January a year ago, the average tariff application across our trading partners was less than 3%. We hit a high based on this estimation of over 27% in April when the news was announced, the big tariff news was announced. And from that point in April, when the markets were gyrating and we were trying to understand what this all meant, we've seen adjustments take place and we've seen negotiation take place. It's become more apparent to us that this is really a leverage feature of how the administration wants to deal with other countries on trade and other matters. As we sit today, and the most recent reading is November, the reading suggests an average tariff rate across all trading partners of 14%. So it's coming down. And it's our view that as we look out into next year and beyond, we think that the ultimate level of average tariffs will somewhere drift down to the 10% level. And so that's our expectation. We think it's going to be a tool that the administration will use at least for the balance of this 4-year term. It's generated almost $200 billion of revenues in the last fiscal year. And for all the reasons the president has espoused, I think he wants to retain this as a permanent part of how we fund government. Now, there's one other expectation we have, and that's the fact that the Supreme Court is right now reviewing testimony and other information regarding the application of these tariffs. Decisions pending at this point. We think the decision is going to likely come in January. And it's our best view that the Supreme Court is likely to take a determination where it's going to curtail or pull back the broad application of tariffs that we have today. We think that the president might have been over generous, or at least over exercising in applying the emergency rules under past legislation. And so we think the Supreme Court is likely to dial him back. We still think the outcome is going to be this kind of average tariff rate of 10%. So that's our view. It's a picture we're going to continue to watch because there's some decisions to be made in the next 60 days or so. On the second bullet, it's the inflation picture. We've been talking about it for 5 years now. It continues. What I've got here displayed for you is a forward swap instrument. It's the 1-year inflation forward swap. I use this as a market signal. It gives me an idea of where people are taking on inflation or selling off inflation risk to other counterparties. And it gives me at least a sense of what the traders, how they view the inflation going forward. It's a 1-year forward look of things. And if you look at this contract right now, interest rate risk or inflation risk is being traded at a level of around 2.42%. That gives me at least some idea of where the traders are moving capital around, how they're hedging risk. And that's consistent to what our view is for next year. We think in 26, we're going to finish the year with a CPI inflation rate year over year of around 2.5%. So that would insinuate we're going to continue to see moderation on price adjustments that are occurring in the 1-year kind of time frame. No matter what, though, the inflation discussion is going to be part of the midterm elections next year, and that's going to be a big part of what the election is going to be all about. If you turn to the next slide, our third expectation goes back to the Federal Reserve, and let me start with the institution itself. And this is probably the biggest change that we're anticipating. We've got a new chair coming in, perhaps in the springtime around May. With this new Federal Reserve chairman appointment, we fully expect that he's going to bring here, and it's one of two choices. I've got on the right the two names that the president has identified, Kevin Hassett and Kevin Warsh. I have every belief that this new chairman, when he comes in, he's going to have an agenda of bringing about change to the institution itself, change that we haven't seen in 40 or 50 years. And it would be my view that part of what they're going to visit will be the analytics and how they go about modeling that leads to decisions. For the last 4 decades, they've been using models based on demand. And I think the new chair is going to come in and is going to reorient the philosophy and the modeling work that they do to suggest more of a supply side orientation to how they model their information. And so that's one of the big changes we anticipate. We have the normal rotational cycle of the Federal Reserve, Federal Open Market Committee members. And so we're going to see that rotation take place as well. We've had one announced retirement. So we're going to have a lot of member change. And it's this committee that votes on the policy rate. So we're going to see change there. And the third level of change is going to be at the just the staffing itself within the Federal Reserve. I've heard in the news the president questioning, why do we have over 1,000 PhDs doing these economic models? I think there's going to be a restructuring that's going to take place over the next 12 to 18 months as a result of this new chair slot coming in. And so there's a lot of change at the institutional level that's going to keep our attention, and something I wanted to mention to everyone on this call. If you turn to the next slide, the Federal Reserve and the FOMC committee will be voting, as always, on direction with the policy rate. We saw 3 rate cuts in 25 in terms of the policy rate. And I tried to illustrate that with the graph on the right-hand side. This is a graph displaying 2 U.S. Treasury yield curves. The black yield curve, the upper one, that shows where yields were December 12th of 24. The red yield curve shows where yields were as of last Friday. And as you can see on the left-hand side of these yield curves, where the 1-month and 3-month bill yields are registered, we've had a dramatic move down in cash related or cash equivalent yields. They've come down substantially from the low to mid 4s. They're now in the kind of the mid 3s. And as we look out over the balance of the next 12 months, we think that the Federal Reserve is going to continue orchestrating this easing path they've been underway. And we expect at least 2, maybe even 3 rate cuts in 26. We expect the policy Fed funds rate to maybe finish somewhere around 3%, maybe even less. And so that would insinuate the left-hand side of these yield curves, or yield curve, is going to come down even further. And at some point over the course of the next 12 months, we anticipate medium and long-term rates to follow suit. Wouldn't be surprised to see the 10-year Treasury yield below 4% and the 30-year Treasury bond yield somewhere in the mid 4s. So we're going to see a continued adjustment in this yield curve. And we think cash yields are going to move at that 3% or lower level. And the last point I wanted to make is that it's going to bring about this normal positive slope to the curve that we've all been anticipating. We've been in a cycle where the inverted curve conditions as long as we've ever seen it. And I think we're moving back towards what I call normal, a positive slope to the curve. If you turn to the next slide. The Federal Reserve released last week their macro point of view about 26. And what you've got displayed here are 3 graphs. What their moving projection has been about next year's real GDP growth, the PCE, which is the personal consumption expenditures inflation index, as well as the unemployment rate. And over time, they've been adjusting their point of view about 2026. And their last reading as we sit today is that they're expecting improving growth, moderating inflation, and I guess you'd call it a stable employment picture. They're looking for real growth in the 2.3% range. They're looking for inflation somewhere in the mid 2s, and they're looking for unemployment to continue to reside somewhere in the low to mid 4s. That's where the Fed stood last week. So that's their outlook for next year. You turn to the next slide. I wanted to share with you my outlook, which is that we think we're going to continue to see positive economic growth. We're expecting real growth next year to actually elevate and accelerate towards the 3% level. And we're also looking for an economy that's going to drive productivity gains. And that's going to be really important given the inflation backdrop that we're still dealing with, the higher price environment. And we think that this kind of modest acceleration in economic growth is going to be brought about in some regards by the supply side policies that continue to be pushed forward, starting with the deregulation efforts that are going on. One thing I would also point, the box down below, that shows the most recent reading on consumer sentiment, the index, the survey coming out of the University of Michigan. And I wanted to give you a profile of last year where that index stood and where it is today. The positive sentiment on this measure has actually been coming down. People just are not feeling good these days. And I think it ties back to the price shock that we experienced in 2021 and it continues to be a hangover effect on, the fact that when you go to the grocery store, when you go shopping, there's, still the residual effects of that price shock. If you turn to the next slide, what about the equity markets? Well, in our view, if you look at the fundamentals, we're coming at the end of this year, and I've got at the top displayed here what the analysts on Wall Street have projected for this year's earnings per share measure on the S&P 500, the 500 companies. They're forecasting, as we sit today, an EPS level of $270.86. That would suggest a year-over-year change in earnings of almost 12%, about 11.5%. We've enjoyed a really strong revenue and earnings growth experience this year in the 500 companies of the index. And that's on the back end of a year last year where in 24 we had 10% plus earnings growth. The analysts are forecasting this year an even better fundamental picture. They're looking for EPS earnings to come in at 309, which would suggest a change of earnings success of over 14%. So if you look at the analysts, the bottom-up estimates on earnings and what the companies are going to be able to achieve in 26, the backdrop's really positive. They're looking for double-digit growth in earnings for the third year in a row. And that leads us to our expectation that we're going to have positive returns in the stock market next year. Now, if you flip to the next slide, here's our target, and I've got it built into this table on the right-hand side. I've highlighted it in orange. My target for the S&P 500 to finish next year is 7,400 on the price basis. Right now, we're around 6,800. So it would suggest we're going to continue to see the S&P 500 index move to higher levels. I'm forecasting with that price target about an 8.5% price change year over year based on where we stand today. And the valuation that would support that price level is a PE on a forward basis of about 23 times 27 earnings, or 26 trailing earnings, I should say. So while we have a trailing PE ratio of about 25 times today, I'm looking for continued valuation support at around the 23, 24 level, modestly lower than this current year stance. And I've displayed for your benefit the other strategists and what the firms are saying in terms of price targets for next year. We're somewhat more modest on our expectations. At the top of the list is Oppenheimer Asset Management. They've got a price target next year of 8,100 on the S&P 500, which represents a better than 18% year-over-year change in prices on the stock index. And that to achieve that, you would need to see a trailing PE ratio of over 26 times trailing earnings estimates. And so they're looking for valuation expansion next year. In fact, I've highlighted for your benefit the four firms in green who are expecting not only are we going to see tremendous stock market returns, but we're going to see that supported by valuation expansion. And those are the four highlighted at the top of this page of this chart. And so the optimism is pretty high. The average return forecast from this audience is over 12% next year. We're looking for about 8.5%. So we're feeling good about next year. We're expecting valuations to somewhat come in or compress and allow the fundamentals to play catch up to the valuation next year. So that's our best view. Now, if you turn to the next slide, what about the other side of the capital markets? What's going on with bonds? As we look at the bond market today, there's one aspect that I really wanted to bring to your attention, and I sourced this from a company called DoubleLine. They gave us a measure of where money market fund balances stand today. And as we sit today, there's over $7 trillion of capital sitting in money market funds on Wall Street. That's a large amount of cash in the cash sidelines. And with rates for cash instruments coming down towards 3% or perhaps even less, we think there's going to be a substantial shift of that capital to go elsewhere. We're encouraging our clients with these messages. For next year, we want to make sure that we move capital out on the yield curve and take advantage of the yields that we see today. We think we're going to enjoy positive returns again in the bond market for our clients. And we think with the idea that recession risk is low, as a theme, we want to emphasize spread exposure, credit risk as a way to contribute to that return. And so those are the messages we're giving our clients, that we're going to make more money again next year in bonds, we believe. And we think you've got to move your liquidity out on the curve and take advantage of the yields that we see today, because they may be changing. You've moved to the next slide. I guess the way I would frame it, our eighth expectation is that next year, given that it's a midterm election cycle, we expect next year is going to be a really noisy year on the political front. We thought this year was noisy. We think next year is going to be even more noisy and louder. And so we're having our clients brace for that, because there's going to be a lot of political chatter that's going to take place next year. One of the things we're preparing for is, we think in the first quarter, perhaps at the end of January, it's quite possible we're going to experience another government shutdown. And I've got on the right-hand chart here a display of what happens in our eyes when you look at the government and they go through a period of shutdown. I've put in this table information related to every shutdown that's occurred going all the way back to 1976. And we've had, as you can see, numerous shutdown events. But I wanted to give you the picture of how long do these shutdown events actually last in terms of days. And they are typically fairly short. The most recent one we had that started September 30 and concluded in November, at the bottom of the page, that lasted 43 days, which is in fact the longest duration we've had in terms of government shutdown. It set a new standard or record. But if you think about it, over that 43-day period, stocks, using the S&P 500 as a kind of a proxy for stocks, actually finished the period up. If you look at the 10-year Treasury note, during that 43-day period, yields actually went up a little bit by 3 basis points. The bond prices ticked down lower. But if you, in our eyes, that was almost a stable condition for bonds. And when I look at this information set going back about 8 or 9 incidences of where the government shuts down, the stock market and the bond market have actually done pretty well. I think if I were to make one point clear, is that I think the markets kind of look past all this. The markets anticipate it's going to be a short event, it's a political event, and it doesn't get too worked up about it. I think that's likely going to be the experience we're going to see next year if we have another shutdown. Number 9, looking at the politics outside the U.S., there's going to be a lot going on. There are 4 themes that I would suggest that we keep an eye on. These are the themes that we think are going to resonate next year. There's this rivalry that's developed between the U.S. and China, and you can see it exhibited in trade and the use of technology. We think there's going to be a continuation of this country somewhat separating from China as it relates to sharing of technology and sharing of the technology equipment that drives technology. And that, I think, is going to be a trend that's going to continue as we perceive and describe China as an adversary. And it's going to lead to, I think, what I call middle powers, some of these other countries that might assert themselves. So that's one theme that we're going to be watching. It's really becoming apparent to us that the use of technology and the use of this new revolutionary technology called AI, that's going to become very coveted and very proprietary. And we think it's going to become almost a nationalized kind of sovereignty asset. And and this country and other countries are going to be very close about how they utilize this technology and how they share this technology. The third theme is just the resource issue. We've got energy resource problems. We've got special and critical rare earth minerals that are needed for the defense industry, for the technology industry. So I think that's going to continue to be at the forefront of the geopolitics that we're going to be witnessing next year. And then lastly, I think we've had some degree of instability on a regional basis over the last 3 and 4 years. That instability, I think, will continue. And I think it's going to continue partly because we have the ongoing challenge in Ukraine. While we brought about some peace, you can describe it as peace in the Middle East, there are still a lot of volatile issues to be resolved. And so the 4 themes for next year on the geopolitical side, the regional instability is the one that I'm going to be probably paying the most attention to. It represents the most risk. And then my last outlook for next year ties to the idea that 26 is going to be a special year. We've got a Winter Olympics in Italy. We've got the World Cup soccer event that's going to take place in North America, centered in Los Angeles, but it's going to include games being played in both Mexico as well as Canada. And then next year is a special year for this country. We're going to celebrate the semi-quincentennial, the 250th anniversary of the signing of the Declaration of Independence. And so there's going to be a lot of celebration and a lot of things taking place during the summer months as a result of that landmark that we're going to go, that anniversary. And then my last mention about next year relates to on the athletic front. I think the World Series is going to it's going to reassert itself again as a dominant news item. We had a great World Series this year, a great playoff experience this year. I think it's going to repeat itself next year. And my prediction is that when the World Series is over, that our New York team is going to actually win the World Series, and it's going to feel good, at least to me. So those are my top 10 predictions. I'd welcome any questions if you want to type those in and send those in. I'd be happy to answer any questions before we move to our next speaker. As I summarize everything I just described, I think we're going to continue to see the administration push their supply side policy initiatives. I think we're going to see the effects of the 2025 tax legislation more. It's going to be more pronounced next year, and I also think the deregulatory efforts are going to continue. If you look at next year, I think just to summarize, I think we're going to have decent growth, real growth in the 3% range. We're going to see inflation moderating. I think you're going to see cash yields moving below 3%. So it's for those that have to deal with balance sheets. For those that are managing capital, you've got to recognize that. I also think that we're going to see a good year for stock investors next year, just like we had this year. I think we're going to see a good year for bond investors as well. So I've got a very optimistic picture that I'm painting next year. And that's the message we're going to relate to our clients as we spend time with them over the next 60 days. So again, if there are any questions, I'd be more than happy to answer any.
Thanks, Keith. We had one question on what your thoughts were on the mortgage rates for next year and what you think may happen to those.
The one I think proxy I keep an eye on would be the 10-year Treasury note. That affects a lot of lending activities, consumer lending. I think it also is an important influence on the mortgage rate as well. So I would pay attention to what the 10-year Treasury is doing. I think it's going to move below 4%, and I think mortgage rates will continue to move to lower levels. I'm not sure as to the pace of that, but I think we're going to see mortgage rates move lower for borrowers as the year unfolds.
Thanks, Keith. We had another question just come in asking you to comment on the risk in private credit and overall debt levels with the economy.
One of the things that's been quite the talk over the last 12 months has been the capital moving into the private credit side of the equation. There's a lot of opportunities to invest in private credit. And a lot of firms are bringing private credit solutions and products through retail registered funds for investors. It's my view that when I look at the private credit sector right now, because I don't see recession risk on the horizon, I'm not overly anxious about it. When I look at the technology companies, the one thing I do know is that they have some very strong fundamentals. They've been expanding their use of the credit to finance their data centers, all of their expansion into AI. So we're seeing some really large debt issuances and debt use being taken on by the technology sector, but they have such strong balance sheet conditions, it doesn't give me great pause right now. I don't think we have a condition right now where we've got an extended private sector situation that would make me nervous. And so as long as the economy continues to expand, as long as default rates stay very low, I think it's going to be a reasonably decent environment for private credit investors. Our primary focus is on the public credit side, and we see some attractive yields available. And we think as inflation continues to moderate, the real yields you're going to be able to get from bonds in general and from the public sector bonds is going to be quite positive. We're going to, the real yield spreads right now are really starting to look attractive, and that's caught our attention.
Excellent. Thank you, Keith. We had one other question come in asking about why do you think most companies have not passed on their increased costs due to tariffs? Great question.
We had a discussion last summer about this, and there are really three levels that I focus on to try to understand who's bearing the cost of tariffs. You've got the companies and the who are outside the U.S. who are bringing products and services into this country as exporters into this country. And I've been trying to gauge the indexes that capture that information set. And I've seen the exporters and their prices start to diminish or come down a bit, which gives me the insinuation that they're absorbing some of the cost of tariffs as they bring products and their services into this economy. The importers who are on the other end of that have also, and I've been following the import price index information, and that continues to suggest to me that they're bearing some of the costs as well. And as a result, not a lot of the tariff cost has been passed through into what I'm looking at on that third leg of the stool, which is the CPI retail level. I'm not seeing a lot of tariff-related costs being passed through into the CPI numbers. And maybe one way to give it perspective, we have a 30 trillion dollar, $32 trillion economy, and we've got import activities that are just north of $3 trillion. So if you think about it, our imports of services and goods represents like 11 or 12% of the overall economy. If those import goods and services have a price impact because of tariffs of 10%, that translates into $300 to $350 billion of additional cost to the goods coming in, and I think it's being absorbed by the companies that are participating in this import activity. And so when you frame it that way, it doesn't have a huge dollar impact. And because of the fact that the importers and the exporters are absorbing this, I think at the final sales level, it's just not a big deal right now.
Excellent. Thank you so much, Keith. We're all caught up on questions. If you have
Great.
additional questions, please log those in and we'll field them before we conclude. Turn things over to Brandon.
All right. Well, thank you, Scott and Keith, and thank you for everyone for joining our webinar today. My name is Brandon Angotti. I'm the Financial Planning Manager with the Wealth Group at Union Savings Bank. And today I'd like to talk about taxes, specifically the One Big Beautiful Bill Act, which I'll refer to as OBA going forward. So for those of you who attended our mid-year review, we talked a lot of, this was a few weeks before it passed, we talked a lot about what could be in the bill, what's being proposed, and what changes could be made. And with the passing on July 4th, we know what's in the bill. Now we can really start and go ahead and doing some real planning around it. So what we're going to talk about today is what was in the bill originally proposed that did not pass, what was in it that did pass and at what levels, and what financial planning strategies can we implement using this new information. The bill was enormous and there's a lot to talk about. What I'm going to try to do today is really narrow it down to the most relevant specific information to our audience today and really focus on three areas: individual income tax changes, estate tax changes, and then also for our business owners on the call, any business tax changes that are relevant. So with that, we'll head to the first slide. So the biggest change that came about was the permanent extension of tax rates and brackets from the 2017 Tax Cuts and Jobs Act. So last fall, there was a lot of concern before the presidential election was finalized of what is going to happen to this enormous bill passed in 2017. Will taxes be going up? Will estate tax exemptions be coming way down? We were able to get get everything finalized and get some real concrete answers through this new bill. So essentially with the passing of OBA, we essentially avoided a substantial tax increase for a lot of Americans through this passing, which is great because otherwise it would have reverted back to the 2016 tax brackets and tax rates. One of the things that's interesting, I think we're going to see in April of 2026 when people are filing their 2025 taxes, I think we're going to see people get slightly higher refunds than expected because of this extension, and then also because of some of the additional deductions that were added in this new bill that we're going to talk about today. For all the parents out there, there was a big change that was made. They are permanently extending the child tax credit. It was $2,000 per year per child. And now it's going to be $2,200 per year, and that's going to be indexed for inflation after. There are some income limitations that you'll see here, but still really, really helpful for parents out there. The other big change was that they permanently extended the larger standard deduction. And what this is going to do is going to reduce the number of itemized filers substantially. And the reason they wanted to do this, because it makes individuals filing their taxes much easier, and it takes a huge burden off the IRS. Typically, people that itemize are audited at a much higher rate than people that take the standard deduction. So by reducing that number, it makes their job a little bit easier as well. There were three pretty important items that taxable items that they wanted to get rid of in this bill. So they're talking about tax on tips, overtime pay, and taxes on Social Security. So 2 out of the 3 passed with some limitations. So income from tips will be deductible up to $25,000 if your income's under $150 single or $300 married filing jointly. It's exempt from federal income taxes, but you still have to pay payroll taxes and state taxes. So just keep that in mind. The overtime pay was also approved, so it's deductible up to $12,500 single, $25,000 married filing jointly if you have the similar income limitations. Only the extra half in time and a half is eligible, not that full piece, but still a nice deduction for people that do receive some overtime pay. They were not able to pass the elimination of taxes on Social Security benefits, but instead they replaced it with a new additional, what they're calling a senior deduction. And the way that works is it's going to be $6,000 single, $12,000 married filing jointly if your income is under 75 or 150. So this is really interesting, and this opens up some pretty big financial planning strategies from a tax standpoint. So if you look at 2025, if you are a senior, you get the regular a married couple, $31,500 standard deduction. Then you also get $3,200 for the age-based deduction, and then you're also going to get this $12,000 senior deduction. So if you make under that 150, you will get a standard deduction of $46,700. So pretty big. So there's 2 things that sort of come to mind when I think about this from a tax planning perspective. The first is it's a great opportunity for tax gain harvesting, and also a big opportunity for some Roth conversions. A lot of people, are familiar with tax loss harvesting, right? That's where if there's a down year, which we haven't really had since 2022, but if there's a down year, you can sell some losers from your portfolio. You can use that to offset some realized gains, or you can deduct $3,000 against your ordinary income, right? With tax gain harvesting, what we're trying to do is intentionally realize gains from our portfolio. The reason that we would do that is because of this. Let's say you're a 67-year-old married couple. You have gross income of $100,000 per year. It's made up of the 2 Social Security payments, some dividends and interest, maybe a small pension, maybe some part-time work, all right? You have that $100,000 of gross income. Now you're going to be able to deduct, let's just use round numbers, $47,000 off your gross income for a taxable income of $53,000. Now, how that relates to the tax gain harvesting is that if you can keep your taxable income under about $97,000 for a married couple, you are in the 0% capital gains tax bracket. So what that means is, in this example, if you have $53,000 of taxable income after this deduction, you can realize capital gains all the way up to that $97,000 mark and pay nothing. You would pay 0 in capital gains on those transactions. So huge opportunity there. The second part is there's a big opportunity for Roth conversions. The exact same example with the couple with $100,000 of income. If they were to take this deduction, you can realize you could do Roth conversions in your portfolio all the way up to about the same level. They're at the 12% tax bracket. The top of that is around $97,000. So you could realize all of those Roth conversions from $53,000 all the way up to $97,000, while still remaining and converting all of that at 12%. Now, the next tax bracket jumps up to 22%. So, it's important if we can fill that 12% bucket all the way up. Huge opportunity for income tax savings now, and especially in the future, because we're going to be reducing your future required minimum distribution. So a few really nice opportunities there with this new senior deduction. A few other income tax changes to talk about. This was one of the most controversial that we saw, which is the SALT cap, which is the state and local taxes. So this is one where, if you're on the call, you're a high earner, you live in Connecticut, this is good news for you. So what they did was they raised the SALT cap to $40,000 in 2025 with income limitations, of course. And then starting in 26, this will raise every year by 1% through 2029. So in 2026, the SALT cap will be $40,400 and so on. This will revert back to $10,000 in 2030. So there is a nice opportunity over the next few years. If you do have high property taxes, if you have high state income taxes, you can use this in conjunction with some other itemized deductions to really minimize your taxes. A new one that came up this year was that there is a $10,000 deduction for auto loan interest on new loans taken during President Trump's term. You don't need to itemize. It must be a new car with final assembly in the US, and there's income limitations, of course. Another interesting rule that they came up with was basically a limit on itemized deductions if you're in the 37% tax bracket, which is the top tax bracket right now. So it essentially reduces any of your itemized deductions by 2/37. So it basically makes the deduction only worth 35% instead of the full 37. So let's say we have a married couple with 800 grand, they have adjusted gross income, 800,000 of adjusted gross income, and they gift $50,000 to charity. The deduction will be reduced by 2/37 to 47,300. So the deduction isn't worth quite as much next year, and we'll talk about how we can do some planning alongside that on our next slide. In terms of charitable giving changes, starting in 26, they're adding a 0.5% of adjusted gross income floor on itemized charitable deductions. So if you're a married couple with 200,000, if you make a $2,000 gift to charity, only 1,000 would count as a deduction. The first half of their AGI, 1,000, you're not allowed to deduct. It's only everything above that, which is interesting. So if you combine that with the new law, with the 2/37th rule, what this does is it presents a really unique opportunity for bunching of charitable contributions in 2025. So by that, what I mean is, let's say you give $10,000 every December to charity. If you were to do 20,000 this year instead, that would have a much bigger deduction than if you were to do 10,000 this year and 10,000 next year, especially if you were in the top tax bracket. If you were to do it this year, you could deduct the full 20,000. If you were to do it next year, you first have to deduct 0.5% of your AGI. And then if you're in the top tax bracket, it would also get reduced again by 2/37. So if you are in that top tax bracket, if you are charitably inclined, a good opportunity is to give a larger gift in 25 to maximize the current laws, and then redo the planning going forward. Another one that's interesting is starting in 2026, there's a $2,000 deduction for cash gifts only to charity, even if you don't itemize. So you don't have to itemize to get this $2,000 deduction. So if you are charitably inclined, this is a great opportunity to get a $2,000 deduction from your taxes in 2026. This might sound familiar. They had a $600 deduction through the CARES Act in 2021. So they are bringing that back, again, just to encourage people to assist with their local charity or national charities, whatever it might be. But a good opportunity, again, for an even larger deduction in 26 than you have now. Some of the estate tax changes that are relevant, the Tax Cuts and Jobs Act increased the exemption, which is about 14 million now, 28 for married couples and 25. This will be indexed for inflation going forward. What this did is it permanently increased the exemption to 15 for individuals and 30 for married couples starting in 2026, and these will continue to go up. We talked a little bit about gifting earlier. The annual gift tax exemption is about $19,000 per year in 2025. That will be indexed for inflation. There is not an inflation adjustment being made for 2026, so it will remain at that 19,000, but still a great opportunity if you'd like to reduce your estate, if you'd like to help out kids, grandkids, family members, anyone like that. You can gift $19,000 per year to any individual without having to deduct that against your lifetime estate tax exemption. So there's a lot of planning that can be done around this in specific situations. Finally, for our business owners on the call, there were two pretty relevant changes I wanted to make sure we talked about. The QBI deduction, so this will permanently extend the qualified business income deduction at 20% with some expanded income thresholds. The other one that's really big is if you are purchasing more items for your small business, they are just now the depreciation expense. 100% bonus depreciation is permanent for all new assets. So if you buy a $300,000 truck, you can deduct the full $300,000 in the year you purchase it instead of spreading that out over several years. So again, a really, really important, really nice deduction to reduce that taxable income for our business owners. And there were some changes that were also made to the Section 179 limits, if there are more specific items that you're buying for your business. So, that's everything that I wanted to cover today. I'd love to open it up to questions. And one thing that I will mention is, if you enjoyed the material and everything that Keith and I talked about today, I would encourage you to check out our YouTube channel. So if you go to YouTube and you search for the Wealth Group at Union Savings Bank, Keith and I have 15 or 16 short form videos up there where each one we spend a minute or two talking about some very specific, relevant topics. So please check that out if you have an interest. But with that, Scott, I'll turn it back over to you and see if there are any questions on OBA or anything else for Keith.
Excellent. Thank you both so much. Really great information you shared with our audience today. This was one of our most attended webinars that we've had in some time. So really a lot of interest in what you had to say. And again, to Brandon's point, if you have individual needs that you want to get addressed with one of our advisors or planners, you'll have an opportunity as soon as we conclude here in about 60 seconds to complete a survey and share some information where we can reach out to you and connect. We did have a question. I'll propose it to our two speakers that we'll be able to share these slides with people in the meeting today.
That's a great question. I know that we are sending out the recording to the webinar. I don't see why we wouldn't be able to share the slides as well, but we'll have to check on that.
Sounds good.
Yeah.
And the question queue is quiet. So with that, we'll conclude for today. Thank you for taking time out of your lunch to join us today. Hopefully you enjoyed the topic and the knowledge share here today. We look forward to having you at future webinars. Looks like a question just popped in. That bunch of thank yous. Perfect. Thank you so much for your time. And if you just hang on for 60 seconds, there'll be a brief 4-question survey. We'd love your feedback. Thank you so much. Have a happy holiday.
Thanks, everyone.
Thank you, everyone. Happy holidays.
Yep.